Yo, what's happening, guys? It is me, Rags to Riches. I'm back again with another market update video. It's been a while since I made this content as I have been very busy studying for my CFP, about 4 months out, as you can see from the bottom right of my screen, from finalizing the education component. And oh my god, I am so happy not to be done with studying, because I still have to go for the CFA after, or my MBA, but just to be done with the CFP, I think has been a long journey, something worthwhile. Definitely have learned a lot from that experience, but I am still here on YouTube, still making content, still trying to help you guys out with things related to investing, finance, saving, the markets, and the broader economy. So on that note, let's get into brass tacks. If you guys don't know me, my name is Rags to Riches. I am a institutional lender by day, a degenerate by night, and then on the weekends I try to have a good time and just chill out because I work a lot of hours. One of the things I most enjoy about what I do is I get a broad exposure to every facet of the wealth management industry during my day job. I get to work with bankers and investors and lenders and deposit specialists and trust and estates attorneys, and they give me this very broad, holistic perspective about finance in the world, which I think isn't really common and isn't available on a lot of YouTube channels. I am by no means an expert. I am, on a relative basis, super young, early in my career, but I feel as though I've acquired enough knowledge which might be impactful and useful to share with you guys. This video, if you don't know, is a weekly market update that I had been doing. I had been a bit too busy and frankly lazy and probably putting too much on my plate to make that content. But, you know, this summer I was dating some crazy girls, saw this Algerian girl. She got dumped because I'm not Muslim and I will not be converting. Was hanging out with this like Muskogee Indian chick who was crazy. The new flavor of the week is Russian, but all these like women stuff has just gotten like too much. So I want to get back to the basics, do what I think is good for me, and that is continuing to work on my public speaking skills with these YouTube videos, and then of course to talk about stuff I personally find super interesting. So on that note, got some articles for you guys today. I want to go through it and then give you a perspective about how it's going to impact you, your money, your personal finances, and the broader economy. Coming in from Yahoo Finance, judge gives U.S. regulators until December to propose penalties for illegal search monopoly from Google. And as you can see here, the GOOGL classic image that we have for Google. Getting into the article, a federal judge on Friday said the U.S. Justice Department until the end of the year to outline how Google should be punished for illegally monopolizing the internet search market and then prepare to present its case for imposing the penalties next spring. Now, the U.S. District Judge Amit Mehta came at the first court hearing where he branded Google as a ruthless monopolist in a landmark ruling that was issued last month. And if you look at the stock price for Google, it's jumped off a cliff because of this article. It's pretty clear to me and perhaps to most people that Google does have a monopoly on search. It is a default option when you buy a phone. Android, iPhone, it is the default option when you buy a computer. I know Microsoft is trying to push back against that with Bing, but they know, we know, everyone knows that Bing is not where you want to be. Google is a monopoly as far as internet search goes. But what I think is really interesting about this article is that while we have headwinds on Google as a company and by extension their stock going into, get rid of that, going into this landmark ruling, we also have new technologies like ChatGPT that are coming out that are really changing the game in so much as how we should be interacting with the internet. No longer do you need to, go into a search, find an article, read it, and then pull out the information that you want to pull out. But you can go into these large language models to actually pull out really substantial information for some basic questions. Now, of course, as you get into like modern contemporary information, the models haven't been trained on that. But it's really cool to see that these new technologies are coming out. That not being said, Google is in the doghouse. It's going to be interesting to see how this plays out. But I mentioned this article to to give a perspective on concentration risk in your portfolios, when you look at these broad market indexes like the S&P 500, the NASDAQ, and you actually look at the asset allocation of those ETFs or indexes, they're heavily concentrated into the names of a few stocks. You could think of companies like Facebook or Google or Amazon or now Nvidia, since it just exploded this year due to the rise of AI. And when you have concentration of those levels within your portfolio, you expose yourself to a level of risk that could be mitigated if you actually bought into other asset classes. I think index funds can make a good, solid foundation for your portfolio. You get a broad exposure to the overall economy while still having exposure to these hyper-growth names, some of those that I just mentioned. But in a slowing economic environment where we have geopolitical turmoil, a new economic regime, and a new political regime coming in with the election, it may be a prudent decision to try to put your eggs into other baskets as opposed to just putting your eggs into maybe broad index funds, but really what that is 30-40% of a couple names, right? So that is the Google article. Getting into stuff that's a bit more relevant and a bit more important, we do have an FOMC meeting coming up in about 10 days' time on the 17th and the 18th. Jerome Powell and his crew from the Federal Reserve are going to be meeting at the FOMC meeting to decide if they will be starting the rate cutting cycle. Currently, the street is pricing in 0.33 or a 33 basis point cut. Of course, the Fed isn't going to do exactly that, but basically what that means is the Fed's either going to cut by 25 basis points or 50 basis points from the federal funds rate. The question, and this has really been the question on the street for the past weeks, months, and potentially, if you think about it this way, year, is how fast are they going to cut and by how much on this first cut? And how we can elude or determine if that's going to be taking place is based on the overall economy. The Federal Reserve has a dual mandate. They care about stable employment and stable prices. And we've seen a stabilization of prices with the cooling off of CPI and PPI. And now we need to start focusing on the overall labor market. And it's starting to cool. As you can see here from Reuters, unemployment falls, suggesting an orderly U.S. labor market slowdown. Non-farm payrolls increased by 142,000 in August. July payrolls were revised down to 89,000 from 114,000. Pause, and just a quick note here. Normally when you're looking at these payroll reports, they're not always going to be 150% accurate, meaning there's going to be revisions like we saw with the July print to oftentimes lower them because, companies may say they're taking on employees, but then they revise it because maybe they fired some people. So the data is usually best after you check out the revised information. Now, the unemployment rate has fallen from 4.3 to 4.2%, but this is from a large uptick that we saw from the beginning of the year heading into the summer. So unemployment rate above 4%, about where the Fed wants it by the end of the year and heading into 2025, but we can expect this to continue to increase as well. Getting into a bit more of the details from the article, U.S. employment increased less than expected in August, but a drop in the jobless rate to 4.2% suggests the labor market was not falling off the cliff like a lot of people were worried about last week to warrant a half-point interest rate cut from the Federal Reserve later this month. The closely watched employment report from the Labor Department also showed solid wage growth last month, which could support consumer spending and keep the economy out of recession for now. I don't know about you, but I spent a lot of time this week on YouTube checking out some YouTube shorts, and then I don't use TikTok because I just think it's really bad for your mental health, but I do get exposure to it via the other social media channels that I get on, and I just continue to see more and more videos of people saying, I am squeezed, I don't have enough money, I can't spend, I need to cut out things from my life, because prices, while the rate of inflation is cooled, prices have not gone down. We have not seen deflation, and wages haven't gone up in line with the increase in prices throughout the broader economy. I remember a time when a dozen eggs cost $2. Now you pay $10 at a regular grocery store for a dozen eggs, and they're not even good eggs with like orange yolk. They're like the yellow processed nasty shit, right? The consumer is suffering. And as unemployment continues to increase, we're going to continue to see weakness in the labor market, causing the Fed to have to start cutting rates more and more and more. My personal bias is the Fed is going to ease into the cutting cycle. We're likely going to see 25 basis point cut when the FOMC meeting happens. But if we continue to see weakness in the labor market, like this article is suggesting, then perhaps we might see 50 basis points. Maybe not this meeting, but the one thereafter. Getting a bit deeper into the payroll report coming in from CNBC, August payrolls grew by a less than expected 142,000, but employment rate ticked down to 4.2%. Read a lot of this stuff in the last article, but I want to see how they broke it down here. So the U.S. economy created slightly fewer jobs than expected in August, reflecting a slower labor market while also clearing the way for the Federal Reserve to lower interest rates later this month. Non-farm payrolls expanded by 142,000, as we know, up from 89K in July. That's a revised figure. And then here is the stat. And the trend is downwards. I mean, I remember 2022 was the period of the Great Resignation. You could apply for a job, have an interview the next day, have a new role with a 30-40% pay increase by the end of the month. And as we've seen the Fed's hiking cycle and companies really start to tighten the belt to deal with these compressed and tighten profit margins, we're seeing that payrolls and job creation are continuing to decline. 142,000 compared to 300,000 just a year ago basically is kind of shocking, right? The unemployment rate as a response to the decrease in job creation is also starting to tick up. This is what I was referring to earlier. We saw a trough of the unemployment rate in spring of 2023 where we hit about 3.4%. Really healthy stat, really healthy print. Companies were tightening the belts but not actually firing employees. And then as we started to head into the end of that year and into 2024, we've seen this gradual increase in the unemployment rate. I like to think of this dip like this dip or this dip. It is a dip and then we're going to rip, but time will tell. Now, the Fed doesn't only just care about the employment market. The employment market is going to be determined, channeled, really driven by the broader economy, how businesses are doing. And we have weak manufacturing statistics that are coming out. And this is just another example of the broader economic slowdown coming in from Jeff Cox from CNBC. The ISM monthly survey of purchasing managers showed that 47.2% reported expansion in August. This was above the July reading, but below the consensus forecast. And this is a little bit concerning heading into the fall where people are going back to school, not spending as much, relaxing, just working but not spending. Summer is when people spend. Why? Because the kids are off school, they have PTO, they want to go out and take vacations and trips, and they want to buy stuff because, summertime, life is good, weather is good, so people spend because that's kind of what we do in America, right? Getting a bit into the stats here. The Institute for Supply Management monthly survey of purchasing managers showed that just 47.2% of reported expansion during the month, below the 50% break-even point for activity, showing weakness in the overall manufacturing sector. The thought was that slightly above 46.8% recorded in July. It was below the Dow Jones consensus for what they were expecting of 47.9%. Now, the manufacturing sector is still in correction territory, according to Tim Fior, the chair of the ISM Manufacturing Business Survey Committee. Demand does remain subdued, but companies are now unwilling to invest in capital and inventory because of federal monetary policy and election uncertainty. It's very challenging for a company to decide if it makes sense to make an investment because of a number of factors, but two that are important. One, they don't know the direction of policy rates moving forward. So why would I take on debt today if I have an expectation or belief that debt is going to be cheaper in the future? And then secondarily, we have this election that's coming up, which is going to change potentially a number of things. One, you have the Tax Cuts and Jobs Act, or the Tax Cuts and Jobs Act that's going to roll off pretty soon, if not extended by Congress. While both the Democrats and the Republicans have a vested interest in extending sections, if not the entirety of the Tax Cuts and Jobs Act, because it did lower tax rates for the average American, the question is how they're going to best do that. One of the ways that the government is going to try to make up for the deficits that we continue to have today is by trying to raise taxes in other places. Likely this is going to be coming from the corporate sector, increasing the minimum corporate tax rate from, I believe it's 18% today, to something else, perhaps higher. And it's hard for a business to decide to make an investment when there's this level of uncertainty about what the future is going to look like. It makes sense we see that manufacturing sector is slowing down, because why would I create a new facility, new machines, new products, new etc., when the entire game might change in as little as 60 days, right? Now, getting into the stock market, we have seen stocks jump off a cliff this week. This is really heading into the FOMC, some of these weak unemployment, payroll, and ISM data that I was just mentioning before. We've seen stocks plunge, with this week being the worst week we've seen since March of 2023. Wall Street ended this week as the worst week in 18 months after a weaker than expected jobs report on Friday, which had stoked investor concerns about slowing economic growth. Tech stocks brought on a brunt of the pain. The NASDAQ composite sank 2.6% as Broadcom, Nvidia, and other tech companies led the market lower on continued worries that their shares had soared too high in the boom of artificial intelligence. No duh. AI is going to change the world. It's going to dramatically change how we interact and work with each other and use the internet, but that doesn't mean that this is a fully vetted, profitable technology today, and I think too much was priced in too soon for the broader market. And a lot of the reason why people are selling off from stocks is, again, about this notion of uncertainty. The Fed has inflation potentially, because you can never say for sure, under control. And if inflation's under control and the unemployment market is not good but healthy, then you don't necessarily need to cut rates. We haven't had real interest rates in as long as I've been investing, for longer than a lot of you who may be watching that are in the Gen Alpha cohort may have even experienced. For as long as we've been around, since the 2008 housing crisis and periods before then, we had a zero interest rate monetary policy and inflation above that. It was cheaper to borrow and then pay back the loan with devalued dollars in the future than it has been. Today, for companies to take on debt, they need to find something to use the money for that's going to produce them a positive rate of return. And because of what the Fed's done, they may not need to cut as aggressively as a lot of people are likely hoping for. Stocks had a very bad week last week. And getting into the FOMC, this is the big question as we head into the end of the month. Market participants are scared. Businesses are scared. The news media is going to be talking about it. Financial advisors are yelling at their clients saying, get out of cash, buy T-bills, buy municipal bonds, buy whatever, because we all know rates are going to go down. The question is by how much? Comments from policymakers this week coming in from the Financial Times suggest that there are going to be some changes on the horizon. In appearances on Friday, Governor Christopher Wallace and President John Williams from the New York Fed endorsed a series of rate cuts this year, given the fall of inflation and softening of the labor market, which we had just discussed. And while their perception of quote-unquote downside risks have increased, Wallace said the economic backdrop requires no action from the Fed to avoid undue damage to the labor market. He said the labor market is continuing to soften but not deteriorate. They want unemployment to rise, but they don't want it to rise in an uncontrolled fashion. If more people are unemployed, they can't spend as much. When they can't spend as much, inflation is going to soften, and then the Fed will be in a position where they may be able to cut because they also need to help and maintain stability in the labor market. Now, getting into politics briefly, we do have Goldman Sachs coming out with a pretty funny article or press release the other day reported on by Reuters. Goldman Sachs sees the biggest boost to U.S. economy from a Harris win. That is quite the photo of the lady. I'm not a political guy. I just don't like her that much. It doesn't do it for me. Now, getting into what Goldman Sachs said from key quotes from their press release, we estimate that if Trump wins in a steep or with a divided government, the hit to growth from tariffs and tighter immigration policy would outweigh the positive fiscal impulse, resulting in a peak hit to GDP of 0.5 pp in 2025 H2 that abates in 2026. Now, if Democrats sweep, new spending and expanded middle class or middle income tax credits would slightly offset lower investment due to higher corporate tax rates, resulting in what they believe to be a slight boost in GDP investment due to higher corporate tax rates, resulting in a slight GDP growth over 2025 and 2026. Basically what they're saying is that they don't believe the income meaning tax income produced by tariffs and tighter immigration policy, is going to help out with growth of the broader economy, despite the fact that Trump wants to cut taxes and allow for some form of deregulation. Whereas while an increase in the corporate tax rate from Kamala Harris and the Democrats is going to be offset by other things that they want to push, like new spending policies, expanded middle income tax credits, etc. It's my personal belief that tax credits, while they can incentivize certain types of behavior, they're not very well known by the American people. It's kind of funny that politicians think that if I give you money to do a thing, you'll do it. But if most people don't even know how to tie their shoes or to save for retirement, how are they going to be making good and effective use of the tax code? I'd like to think they're not, because even I don't have a solid understanding of the tax code, and I just studied it for the past 3 months of my life. Anyway, just kind of my 2 cents, right? Now, getting back into tech news to close out our conversation on the markets this week, we do see U.S. implementing new controls on advanced technologies alongside international partners. Coming in from Karen Freefield from Yahoo Finance, the United States on Thursday published new controls on advanced technologies, including quantum computers, in line with restrictions imposed by international partners. Now, they believe that these actions are going to ensure that the U.S. export controls keep in step with rapid evolving technologies and are more effective than when we work with just by ourselves. It's better if we do this in a coordinated fashion. And the usual suspects are, of course, key. UK, France, Switzerland, Germany, many of the EU countries are in line and in lockstep with this behavior. Now, essentially, what they are trying to accomplish with this is shoring up the US's stage and place in the broader quantum computing market. Quantum computing is a new form of computer where instead of using binary code to make decisions and to process information, meaning zeros and ones, I believe quantum computing is using 3 numbers instead, 0, 1, and 2. And that additional level of complexity allows the computer to be extremely, extremely more rapidly powerful. So it's good to see that we're at least trying to show our interest in this new and evolving technology. Now, interest rates are very important for the housing market. As you can see here, the 5-year Treasury, and I'll show you the 10-year Treasury in a second, are in a steep decline. We have seen yields for the 5-year Treasury go down from 4.57% to 3.496%, and this is just in a period of 2 months. Rates have gone down dramatically across the board, and this isn't being priced into all forms of consumer debt. Many mortgage lenders are still tepid to get back into the industry given uncertainty about the direction of rate cuts, and also trying to shore up the profitability of their loan book given some of the regional banking issues we had of March of last year. But as yields continue to decrease, then lenders are going to open the floodgates for increased deal making activity, and much of the move that we believe is going to take place in the FOMC meeting, I believe, is already priced in. I mean, just look at the chart, man. We're lower than where we were in August when everything in the world was about to fall apart. 10-year Treasury reflecting the same thing. Let's go to the 1-year chart so it's a little bit more clear here. New low, breaking down, next level of resistance, likely going to be around 3.5%, but the yield curve is starting to get back to an uninverted place, which is good. And to round us out for the day before I show you guys my portfolio, just want to show you guys that housing payments finally have dropped to their lowest level since January. Home sales still are falling. Coming in from Redfin News, who is a real estate company that's very involved in the residential real estate space, the weekly average mortgage rates have fallen to the lowest level in a year and a half, and that's saving home buyers money, even though home sales prices are near record highs. As of today, the median U.S. housing market or housing payment fell to $2,534 during the 4 weeks ending in September 1st. And this is the lowest level since we saw in January, where a lot of people thought the Fed was going to begin to cut. So they started to price that into the bond market and by extension, mortgage rates. Now, declining housing payments have yet to improve home sales. As of today, pending home sales fell 8.4% year over year, and this is the biggest decline in nearly a year. Some would-be home buyers are still on the sidelines because they're still priced out of the market, and Redfin agents are still reporting that some buyers are waiting for more clarity on what the new National Association of Realtor rules might mean for real estate agent fees. For anyone not familiar, when you get into a real estate transaction, historically, and what recently is going to be changing, is that you would need to pay a fee to the realtor, both the buyer and the seller, resulting in a 6% transaction cost, which was recently ruled as illegal. So as we get clarity on what the new National Association of Realtor rules are going to mean for real estate agents, people will begin to re-engage in the market as they know if that expense is going to be applicable or not. I don't think this is going to be like the end-all be-all maker of the housing market, but it's something to pay attention to, because if realtors no longer have an incentive to engage in the market to sell properties, we may see a slowdown or continued slowdown of home sales as they're not actively being marketed in the same way that they were. And in a final note, we are seeing an increase in the housing supply coming in from Realty Plus. The U.S. housing supply sees a significant uptick. The number of homes nationwide grew 35.8% annually in August. This is the 10th straight month of growth, and is at its highest level since May of 2020. An online property portal said. New sellers did pull back from the market though, with 0.9% fewer homes hitting the market in August compared to last year. The big thing with real estate are two factors: volume, and volume is going to be driven by inventory, and interest rates. Interest rates are declining. We have increasing volume picking up in the market. And when we see rates go down to a place where the average consumer can get back into the real estate market, I do expect it to continue. I don't know if we're going to see a housing market crash. I'd be very hesitant to say that is the case. Now, in the last few minutes of today's show, guys, I want to show you a quick update on the portfolio. We have been doing pretty good. I think when I had last showed you this, it was around, well, I can actually tell you, because I think I made a video in June. Yeah, back in June, the portfolio was just shy of $200,000. We have seen a pullback, which is more than okay, primarily being driven by my crypto holdings. But basically, we got 33K in the 401k, 50K in my thematic growth account, a little bit of Bitcoin, some dividend stocks. I made a new portfolio, which is having assets that produce ordinary income from fixed income securities, options, or covered called ETFs, a commodities ETF, and then a precious metals ETF. Can try to bolster that out with an HSA that I had made for a little bit of tax deferred growth, baby. T-bill ladder continues to do exactly what it does, capturing those yields prior to them decreasing. I got these rates locked in until March of 2025, and I'll continue to roll these into lower yields as needed. I keep them in T-bills as I need them to be liquid, and as one T-bill rolls off, it's rolled into a new month at the end of the ladder. The idea is that instead of using a savings account at a bank or at a high yield online lender, which is going to offer a yield lower than what the fixed income securities are going to offer me, I'll just use the T-bill ladder instead. And then I have 6 months, each for about $4,000. One is in a money market fund where if I needed it immediately, can immediately tap into it. The remainder in T-bills to continue to capture that income. Altcoins, I remember when this was $35,000. Should have sold at the top, but I have diamond hands and I don't want to pay taxes on that. Private credit, doing what it has to do. Got a little bit of cash, got a little private equity, got a little bit of venture, and then I got some cash as well. Now, my portfolio has traded sideways since the start of since the end of the crypto peak, but we continue to outperform the market. As an example, if you put in $10,000 into my portfolio, right now it'd be worth $11,500 compared to the NASDAQ of $10,299, and then the S&P 500 of just shy of $11,000. And this is represented through the chart here. A lot of this growth was driven by the rise of crypto. As crypto continued to cool off, the equity markets began to pick up, and that's reflecting in the charts here. I make a mean portfolio. I invest into it monthly, try to put in about $2,200 per month, and then the returns are reflecting the amount of capital that I'm putting in. I could show you guys the charts in Weeble, but I don't know if that would be too much of value add, so I'm going to end it here for the day. I want to thank you guys all for watching. I really do enjoy making this content for you. Frankly, and kind of selfishly, I do it for myself so I can just get a good grasp on what happened for the week. It's really easy to learn something when you speak it out loud and try to think through it live, potentially on a recording, and that's a lot of what this is. But if you do find my ramblings interesting on the internet, be sure to like, subscribe, and share. If there's any specific content that you want me to make, just let me know in the comments section. I'm trying to get into more long form videos that are more advice oriented in nature. I feel as though I've gotten to a point where I have some interesting insights to share as far as broader wealth planning and wealth strategy methods, and I'd be more than happy to make content about that as well. And something which would be super cool is getting somebody on a podcast to just like pick their brain, hear what they think, and really learn more about their experience and work in the field of financial services. Now, this is Rags or Riches, so I appreciate you all taking the time with me this Saturday afternoon. I wish you all the best. Be sure to enjoy yourself, as we are going to be corporate slaves again in just about 36 hours. But for the limited time that we have together, I hope you enjoy it. Hope you enjoy your day. Keep well, and we will talk soon. Bye now.